India's power sector doesn't run only on plants and transmission lines, it runs on capital. Behind every major power project, there is one company that plays a critical role in deciding whether the project moves ahead or stays on paper. It doesn't generate electricity, yet for decades it has funded India's power infrastructure, working closely with the central and state utilities. In this video, we will analyze its standalone financial performance, loan book quality, risk, and long-term outlook to see whether this power financier deserves attention from an investment perspective. I am Sebi George. Welcome to Decoding Equity. Let us uncover the story of this power sector giant, Power Finance Corporation Limited. Before we begin, a quick disclaimer. This video is strictly for educational purpose only. I am not a SEBI registered investment advisor and this is not a buy or sell recommendation. Please consult your financial advisor before taking any investment decision. Let us see why PFC needs our consideration or why it is a standout company. PFC is not just another NBFC, it is the financial backbone of India's electricity ecosystem, funding power generation, transmission, distribution, renewables, and power reforms. When India talks about 24 by 7 power, electrification, and energy transition, PFC is always in the background financing it. Power Finance Corporation holds about 52.6% stake in the REC Limited, Rural Electrification Corporation, making it the majority promoter after acquiring this controlling share from the government in 2019 March. This strategic ownership strengthens PFC's role across the power financing ecosystem. Most of the PFC's lending is to state utilities, central PSUs, and government backed entities. This gives it lower default risk, predictable repayment, stronger government support during stress cycles. Unlike many PSUs that struggle with returns, PFC delivers consistent interest income, maintains healthy spreads, generates high absolute profit year after year. That is rare in large cap government owned finance companies. The power sector today is very different from 5 7 years ago. The distribution company reforms, better payment discipline, central government monitoring, and the security mechanism like LC backed payments. As a result, NPAs are controlled and recoveries have improved. India is entering a multi year power capex phase. Grid expansion, renewable integration, storage and transmission upgrades, EV and data center power demand. PFC does not need to find growth. Growth will come to it automatically. PFC has historically been a high dividend paying PSU and dividend payout is 4.4%, making it attractive for income focused investors, long term holding portfolios, conservative investors who value cash returns. This is one reason institutions continue to hold it. Despite all this strength, PFC still trades at a reasonable valuation multiple. The price to earnings multiple is currently lower than its recent historical average. That valuation gap is exactly why the long term investors keep tracking it. Let us get a view of the past performance. Even though the past performance does not guarantee future returns, it can act as a useful guide. Looking at quarterly standalone sales, we can see a clear structural uptrend. Revenue has grown from around 10,000 crore levels in FY23 to consistently above rupees 13,000 crore in FY25. While there is normal quarter to quarter volatility, the overall direction remains upward, indicating loan book expansion and a stable interest income. This chart shows PFC's quarterly standalone net profit trend over the last 3 years. Despite normal quarter to quarter fluctuations, profits have moved from around 3,000 crores levels in financial year 23 to above 4,400 to 5,000 crores in financial year 2025. The peak in March 2025 reflects the improved earnings base, while even the softer quarters today are significantly higher than the earlier years. Power Finance Corporation's asset quality has improved sharply and consistently, and the numbers clearly back up. Gross NPA has declined from around 8.4% in FY22 to about 3% by March 2025. This reflects strong recoveries from legacy power sector stress and minimal fresh slippages in the recent years. Net NPA has improved even more meaningfully, falling from around 2.2% in financial year 2022 to just about 0.4% as of March 2025. Looking at institutional shareholding, FII holding in BFC has steadily increased from 16.5% in March 23 to around 18.3 by December 25, showing rising foreign investor confidence. At the same time, DII holding has moderated from about 18.6% to 15.5%, indicating some domestic profit booking. Overall, the institutional ownership remains strong, with the foreign inflows clearly offsetting the domestic selling. Power Finance Corporation raises funds mainly through the domestic bonds, bank borrowings, tax-free bonds, and overseas ECB bonds backed by its AAA credit rating and PSU status. In the current interest rate environment, PFC's average cost of borrowing is around 7.4%. Despite this, its strong pricing power and improving asset quality helps to maintain the healthy margins and the stable profitability. This margin stability ensures steady interest income and predictable profitability. Being a power sector lender, PFC's loan book is naturally concentrated among large power utilities and state distribution companies. However, this concentration risk is mitigated by the government backing, long-term project visibility, and improving cash flows in the power sector. Top 10 borrowers constitute about 40% of the loan book, which is not a warning sign. PFC combines strong asset quality, stable margins, rising institutional confidence, and government backed execution strength. In a sector where the capital demand is structural, as I said earlier, PFC does not need to find growth. Growth comes to it automatically. With improving fundamentals and sector tailwinds, it remains well positioned for steady, long term value creation. That's all for today's analysis. I hope this helped you understand the business and the numbers better. This is Sebi George from Decoding Equity, signing off.